Once a company has reached a relatively advanced state of development, they may become eligible for venture capital financing. By eligible, I mean the venture capitalists may actually look at you and think about investing in you. Although that's happening at an earlier stage these days than it used to, and in smaller amounts. So you may come across some of these considerations at an earlier stage than perhaps a company 10 years ago would have. When an investor comes in, the first decision is, what form will investment take? Typically, VCs will want to put their money in the form of preferred shares. If you don't have preferred shares yet, it'll be a Class A preferred. The typical investment involves what's called a single dip, or sometimes a double dip, liquidation preference on the shares. A single dip is where the investor gets their money back in a fire sale of the company. But if the company succeeds and is sold for a premium, then the investor would convert to common shares and share with all the common shareholders from $1 upon a sale of the company. A double dip is where the investor gets their money back and then shares with all the commons. Those two are the most common forms of preferred equity that we're seeing in venture capital transactions. Venture capitalists do have a number of sort of typical standard provisions that they like to put in place with their companies. The VCs like to ensure that their equity position in the company is protected, so they like to have effectively vetoes over the creation of new higher ranking classes of shares, sometimes over the issuance of shares at all, aside from issuances under the ESOP and so on, which from the company perspective, we generally tend not to like. They will also have provisions protecting the use of their money by the company. So restrictions on budgetary spends, capital expenditures, non-arm's length transactions, and that type of thing. These are typically called protective provisions. Sometimes they'll appear in the articles of the company, sometimes they'll appear in the shareholders agreement. VCs will typically want one or more members on the board of directors. That can be, sometimes they'll ask that the board of directors be reformulated so that there are VCs, founders, and independents on the board who represent swing votes and so on. Some of the other things that venture capitalists will typically look for are registration rights. That's the ability of the venture capitalist to cause the company, once it's a public company, to register their shares for trading on a stock exchange and so on. And information rights. That's the ability to require the company to deliver monthly, quarterly, and annual financial statements and obtain other information regarding the company. So there are a number of things that venture capitalists will ask for in venture capital transactions, and you should expect that the company will be significantly changed by even a modest venture capital investment.